We are half an hour away from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: Asian stocks rise after a rally in U.S. tech heavyweights, with investors focused on earnings as a major test of sentiment on equities.
Tesla jumping in late trade with the promise to fast-track cheaper models, taking the spotlight from the ugly sales and also the profit numbers.
And China steps up the rhetoric ahead of Antony Blinken's visit, blasting U.S. claims of overcapacity and accusing it of curbing China's development. All right, quick look at the market action here this morning. You're seeing a pretty good risk rally across the board here in Asia, and really got to thank Tesla for that. That after-hours trade, the pop in those shares, really lifting U.S. futures higher, is really helping Asia here up some 1%. And we're seeing some of these tech-heavy gauges really catch a bid here this morning. Taiwan just coming online here. We're up more than 1.5% in the TAIEX. The Kospi also up, and as well as the Nikkei, close to 2% gains here as well. You also saw when it comes to the S&P, the best back-to-back rally we've seen in about 2 months or so. So, obviously the U.S. tech earnings are in the spotlight here this morning. Despite those Tesla numbers, we'll get to that in a little bit, though. They missed on basically all fronts, but the announcement of cheaper models, the talk of this robo-taxi certainly did help lift the optimism there. The miss on the U.S. PMI numbers was also quite telling as well. That took some steam out of the dollar. It also took some steam on that sell-off when it comes to bonds as well. So you do see yields dropping, but actually stabilizing a bit here in the Asia session. But yes, it was a pretty solid bond auction for the 2-year yesterday as well. So that's why we're about 490 for your U.S. 2-year yield. Gold is also down for a second straight day as well. There's also, keep in mind, a Bank Indonesia decision a little bit later on here today. It's pretty much leaning towards a hold, but there's a fraction of economists out there that still think that they could hike, just given the slump that we've seen in the rupiah. So something to watch out for. Nasdaq Golden Dragon saw a pop, especially when it comes to these ADRs in the tech space here yesterday. So that certainly is going to help how things go in Hong Kong, which Dave has talked about, right? The Hong Kong market has basically been the best in the world in terms of equities this week. So it's only Wednesday, but still, it's been an outperformance that is worth noting. We talk about those southbound flows, basically 17 straight days where mainland investors have been net buyers of Hong Kong stocks here. So that certainly helps to set up here for today. You take a look at how futures are set up here this morning. There was some lines from some of the FX regulators talking about the exchange rate a little bit as well. Futures are pointing higher here. We talked about, there's a red head that just crossed about bond yields hitting the record lows. This is in the credit markets, I believe, in China. But we're watching ever so closely that China 10-year yield still at 223 and 725, 26. There you go on dollar China, Dave.
Yeah, to be more specific, Yvonne, on the breaking news that you just mentioned there, it's a 2.25%. That's the record low. That's the yield. That's a yield effectively that you get here on AAA rated 3-year corporate notes in China. So that's a local currency bond yield, 2.25. You look longer at longer-term tenors, the 10, go all the way to the 20-year. Similar trend. We talked about something similar yesterday with LGFVs, and borrowing costs are also falling as well. So keep that in mind. We'll watch that very, very closely. The CGB yields, of course, we've been tracking the rally there, and the 1 year has been effectively nearly almost taken out the 2023 low. And that, all that being said, a couple of things to tell you about today. EV makers, obviously on the back of Tesla earnings and Tesla guidance as it pertains to that specific price point of the market. This news just dropping about 5 minutes back on the EU. And, we did get a sniff of this, I would say, about a week back, opening this investigation into medical device procurement. So that group of stocks will be in focus today amidst really what's taking place, this world-beating rally in Hong Kong so far. So the first 2 days of the week, a lot of the benchmarks here in Hong Kong are top of the league table so far. Earnings out of HKX, you have a trading debut here today. Yesterday's debut was any guide. I guess close your eyes if you're long this one. All that being said, it could be completely different, of course. Antony Blinken is in China. More on that in the geopolitical conversations a little bit later in the show. Yeah, so it's extremely busy as we head into the Wednesday session. And we haven't even talked about Tesla.
We haven't, and let's talk about it now, because you talk about the after hours trade, and certainly, despite how bad those earnings were in the first quarter, there was quite a bit of optimism, right? So basically, they promised us to ramp up the launch of more affordable models, and following a decline in first quarter profit margins and sales. Let's bring in our Asia transport reporter Danny Lee. He joins us from Beijing here this morning. Danny, there was a lot of questions about the robo-taxi, a little bit about what the strategy is going to be around these cheaper, affordable models. What was your take from this earnings call?
Yeah, I think it was important that Elon Musk gave some clarity on how Tesla will grow in the next several quarters, specifically around lower cost, affordable models. It's not just one, but there would be many of them coming forward down the line. But specifically the fact that in the last earnings call, in the previous quarter, we heard that Elon Musk and Tesla would go for a more lower affordable model that will come out towards the back end of 2025. Now they're bringing that forward to around early 2025. So that brings forward potential growth by around 3 quarters. And that's important because, as Tesla signaled previously and also overnight, that it's going to suffer and face notably lower growth into the rest of this year. And that's a challenge for them because as they face huge and more EV competition, they're cutting prices to kind of spur more demand. It's not necessarily working as we have seen. Therefore, earnings has taken a bit of a hit, particularly in the first quarter.
So, apart from the affordable models and I guess the conversations around whether or not that could also lead to future margin compression, what else stood out to you, Danny? Mixed bag, of course, when you look at other metrics.
Yeah, I mean, for the earnings front, clearly margins still down, but better than it had been expected. And when you see revenue and the operating result, that was lower than what the market and the street was looking for. Tesla has been on this cost-cutting drive. We saw them last week cut 10% of the workforce, and clearly in some divisions closer to 20%. So this, Elon Musk said, they're going to keep on cost cutting in order to get into shape. And so as they have lost a number of key executives as well, as they push forward with this lower affordable model, it's going to be very important to see just what they deliver on this, because Elon Musk, as he's made some big pronouncements in the past, he has not been able to deliver exactly on the timeline. And when you see something like the Cybertruck, which has just emerged, that took 4 years from when it was originally announced. And so therefore, can Elon Musk deliver on something like a robotaxi or even an affordable EV model, whichever comes first and in which form, in order to help kind of revive this earnings momentum, which has kind of declined on the back of a lot of negative news flow of late.
There we go. Danny Lee for us, unpacking the Tesla story in Beijing for us, where really, if you think about it, the competition coming from Chinese EVs, part and parcel to this Tesla story. Let's stick with big tech. Let's stick with China. Let's talk about Apple this time, though. Independent research firm Counterpoint Research reports that Apple's iPhone sales in China fell 19% during the March quarter. Now, the drop marks the gadget's worst performance in the country since 2020. For more, let's bring in our executive editor for Asia Tech, Peter Elstrom. He's joining us on the line out of Tokyo. 19%, Peter. I guess it shouldn't come as a surprise, given the initial prints that we've seen for January and Feb. I guess the question is there an end in sight to the weakness coming through for this specific product in this specific market?
Yeah, you make a good point. We have gotten bits of data ahead of this, including some shipments figures for Apple and the other smartphone makers in China. But make no mistake, this is a bad set of figures for Apple. Watching their sales fall about 19% in China. That's significant for them because this is their biggest market outside of the U.S. We know that they face some headwinds there for a number of different reasons. Probably the key in the first quarter was the rising competition from Huawei, the company that's been blacklisted by the U.S. They weren't supposed to be able to get some of these semiconductors to power their smartphones, but in fact they've been able to make them domestically. That's created a ton of demand. There's been some nationalism behind that that's driven support for sales of the Huawei devices. On top of that, as Bloomberg has reported, there are government agencies that are banning the use of iPhones in certain contexts within the country. So that's created a ton of challenges. Tim Cook, the CEO, of course, went to China. He's been trying to make sure that he can do whatever he can to salvage that market and make sure that they help sales as much as they can. They open a new store in Shanghai to be able to drive sales. But it's becoming increasingly challenging for Apple to make progress in China, which is such a critical market to its future.
Yeah, amazing how this Huawei comeback has played out, Peter. It doesn't look like Apple's going to be coming out with any upgraded handsets or anything until the fall. So what can they do to really prevent more market losses now in the near term?
Well, they have been taking a number of steps. You're exactly right. Apple has a very fixed rhythm of introducing new handsets in the fall. They try to come out with something that's going to tempt buyers. That's been a struggle for them, not just in China, but more broadly. They've been struggling to show enough improvement with each year's new device to be able to spark demand, as they did for so long in the past, of course. In China in particular, we've seen them cut some prices. They're trimming a few different models within the country to try to drive prices. They're also opening up some retail stores. Again, Tim Cook is taking it very personally. Tim Cook built the supply chain that Apple uses through China. He's been visiting the country, very vocally supporting their operations there. They feel like it's a very critical part of their operations. So they're doing what they can, but Apple is struggling at this moment, and China may be a bit of a reflection of broader challenges globally, where they're trying to move into some of these emerging markets and also boost sales there. But to be clear, their prices are very high, so they're at the premium end of the market, and they need to be able to stoke some demand at that end of the market.
Peter Elstrom, thank you. Our executive editor for Asia Technology joining us out of Tokyo this morning. Still ahead, we got IO Fund telling us how Wall Street is underestimating really the impact of BYD and other Chinese EV makers snatching away market share from Tesla. The lead tech analyst, Beth Kindig, joins us in the next hour.
Right, and we'll take you straight live now to the U.S. Senate, where they are set to vote on this bill, of course, and almost this everything in the basket sort of bill here, Ukraine aid, TikTok divestment, or ban. So we'll bring you the latest out of the floor in D.C., plus, of course, the Open coming up 18 minutes away. You're watching The China Show. Happy Wednesday. All right, if we cut the week short here, we could do a victory lap and open that bottle of Bollinger right now. So Monday, Tuesday, Hong Kong markets, Hong Kong equity markets are really top of the global table this week. So I think 3 out of the top 6 benchmarks are all in Hong Kong. HS Tech is up 5.2%, HSI, HSCI. We're also looking at, and we'll talk more about this in a moment, 18 straight days or 17 straight days of net flows into Hong Kong through the Stock Connect. So it's been a good period of time here for Hong Kong equity markets. Reference rate of the day, bottom of your screens. Let's talk equities now. John Lin, China Equity CIO, AllianceBernstein, is here with us in sets. Nice to see you.
Good seeing you.
Sentiment has really picked up? Question mark.
A little bit. I mean, over the last year, right, since the COVID-0 policy, the economy is stuck in this sort of weak pattern of recovery. But every 3 or 4 months or so, folks sort of say, well, there's going to be more stimulus. Don't worry, it's going to come. And the market runs up. And the stimulus doesn't come and people get disappointed. Or the short-term data gets a little bit better and people get excited. And then the next set of data is not as good. And the market comes down. So it looks like we're still in this pattern. Okay. But the most recent data does look like a little bit more promising than before. So let's see what the next set of data brings. But what it does, the larger pattern does point to this is sort of grinding up, right? Things are getting a little bit better. Not in a hurry, but they are not worse than before.
So, I mean, are we seeing that reflected in earnings growth, for example? The fundamentals changing a little bit, macro picture looking a little bit. I mean, what did you make of this earnings season so far? I think we're about 90% into it now.
So the picture is mixed. And I think if you look at some of these very domestic-oriented companies, the numbers are still not great. And so really it's about the second quarter and forward, but not sort of first quarter or fiscal 23 and backward looking, because those set of numbers are not particularly impressive.
Yeah.
So I think we have to wait and see.
What are the bright spots?
The standouts, yeah.
Yeah, if I look more narrowly at our own holdings or our portfolios, the set of companies that have both a dominance in domestic market with their products, right, machinery companies, bus makers, etc., but very crucially, a very large export business, particularly to what we call the global south today, but basically other emerging markets, Middle East, Southeast Asia, those companies are doing particularly well. Because of this booming demand from places like Saudi Arabia when they are building, 50 resorts all at one go on the bank of the Red Sea, for instance.
Obviously, we've been talking about this 9-point plan that came out once in a decade. How important is it as a value investor yourself to be seeing this sort of change? Do you think it's important to note that policymakers are putting capital reforms as sort of a priority now?
We think it's a huge deal. It's probably something that's being underappreciated by the market, certainly by folks who aren't really looking at China day to day. And these sort of capital market guidelines comes out once a decade. And the last couple ones in 2004 and 2014 kind of set up the Asian market as we know it today. And we think the newest set of the 9-point guidelines are really a reflection of the maturity of the market. So it's no longer about, let's get all the IPOs or small companies as much as possible into the market, but it's now emphasizing protecting shareholder rights, enhancing shareholder returns, and as a fiduciary to shareholders, we love that.
And is it actionable now? Do I have to wait a few months, years? And how do I act on it now, if it is now?
I think it's still is already taking place. If you look at things like dividend payouts or even the instances of announcements of stock buybacks, those are definitely picking up. Okay. So the regulators or the exchanges are, I think, nudging companies, especially SOEs, to start actioning some of these items to return. And if I take a step back and sort of maybe compare more broadly across, of course, a lot of attention is being on Japan and how well they've done in terms of their own, wasn't called Value Up back then, but similar set of programs on governance reform and what Korea has begun to do. I think there's a little bit of one-upsmanship sort of between the regulators and between the companies, which is they've done it. We got to be able to do it too. We can maybe do it better. Again, if the result is better return to shareholders, bring out.
It's one thing that what regulators are doing. I'm just wondering, is it also just a symptom of these dividend payouts is because domestic demand is so weak and CapEx plans have been pulled back that we're seeing so much of this kind of return to shareholder growth right now?
There's no other better use of the money.
And if things get better, does that trend sort of change?
So on what you said before about maybe lower set of demand, so the capex plans have come down, etc., and therefore making more cash more available for the dividends. That's absolutely true. And in fact, dividends is a fairly recent phenomenon. And so the way we run our fund is quant plus fundamental. So we have our own quant model. But interestingly, when we first started 15 years ago, dividend yield wasn't in our model because there was just no dividend yield. Like if you remember 15 years ago, Chinese companies, the mantra is if you build it, they will come, right? And so if you make money, you want to build another factory line. It will get filled, don't worry. It's really until 2014, 15 for us that we found dividend yield as a factor to start becoming effective because they finally arrived. And I think now we are reaching a stage where the dividend paying behavior has really become more common because that's a way viewed as a good way to compensate or reward your shareholders. So absolutely that's something that's going to affect the market.
Do you think, how does this affect growth strategies where you typically don't really get, dividends aren't usually part of what people consider to be one of the top factors why I'm picking China, for example, because you look at Hong Kong, you know, the benchmarks here are very heavily weighted towards these growth stocks, for example.
Yeah, so a couple of things. One is that the definition of growth and value sometimes gets blurry because, as you pointed out, some of these Hong Kong stocks are heavily tech stocks, heavily in the benchmark. They've come down in valuation, first of all, and second of all, some of them actually started paying quite healthy dividends.
So they're trading like value stocks.
They are behaving like that, value stocks, if you will. So I don't know if you wait long enough, everything becomes a value stock eventually.
If we wait long enough, we're all dead. But, you know, that's the economist joke over the long term.
Indeed.
John, we got to leave it there, but thank you so much. Great to see you in town. John Lin there, Chief Investment Officer of China Equities at AllianceBernstein. All right. This is not good news once again.
Disaster.
I didn't want to do this, but now we're talking about this other trading debut in Hong Kong here today. So yesterday, it was more about bubble tea. Today, we're talking about Mobvoi. This is the Google-backed AI startup. There you go. We're seeing another slump, really, in the first day of school there. We're down some 21%. We'll see how this all plays out. But yeah, the IPO market this week just really hasn't been going well.
No, and
despite being the busiest.
Ironically enough, HKX is coming out with earnings today.
Yes.
So yeah, you got to wonder what the pipeline looks like. We'll take it straight back to DC, where we understand the U.S. Senate now has enough votes to pass the Ukraine-Israel aid package. There we go. We'll leave it to like picks there. More details coming up, plus a preview of the Wednesday session ahead. You're watching The China Show. All right, 17,000. Here we go again. Nth time lucky. We're looking at HS Tech, and there we go. We're back above 6,000 on the Hang Seng China Index. So at these levels, we should be at the very top end of the recent range. Should be the top of highest level of the year so far. So we'll see how we end the day. Bullish break has loomed. We closed above it yesterday, and we'll see if we remain above it by the end of the session.
Yeah, take a look at some stocks to watch here. We talked about, you know, whether it's the Tesla supply chain, whether it's these new trading debuts that we've been talking about this week as well. Take your pick. Mobvoi, there you go. We continue to see those declines of 21% or more. Certainly this was supposed to be a pretty interesting week for IPOs, and whether this was going to really revive the market here. The last three have not been pretty. We have the open coming up next. This is Bloomberg. Welcome back. You're watching The China Show. We're counting down the opens on markets, and we continue to watch this rally take more of momentum. If you take a look at whether the Tesla effect really that's lifting markets here this morning, you got to also talk about the data that we got in the U.S., which really kind of helped fade that sort of higher for longer narrative as well. So that's why we're seeing tech deliver here today, and we're certainly watching very closely those levels on the Hang Seng, Dave.
Yeah, 17,000. We're just a little bit below that right now in your pre-market, so we'll see if we cross above that. 6,000 on the Hang Seng China Index. HS Tech has done exceptionally well this week so far, up 5.2% Monday and Tuesday. And in a couple of seconds, you'll see what it opens up into as well. And in a couple of seconds, you'll also see some of the moving averages to focus on. We're starting things off with the CSI 300, which just about is sitting closed right below a key level yesterday. We're a little bit above that as we speak. Hang Seng Index, not 0.9%. As we pointed out, 17,000. MSCI China is almost reversing all of the losses so far this year. But as you can see, a rally out of the gates. We do have a bond auction today, I should tell you about. I think it's 2025 bonds, 125 billion, if I'm not mistaken here. Speaking of local currency bonds, AAA rated local currency bonds, the yield there has hit a record low as of yesterday, 2.25%, just to mention that as well. Small caps also doing well in the opening minutes. Flip the boards, please. So we talked about Tesla U.S. futures are pointing higher on the back of those earnings, that 13% move in the after-hours trade. You are getting a follow-through across some of these EV plays as well, Xiaomi, and you are getting also some guidance coming through out of CEO talking about, speaking of margins on Tesla, margins guidance out of Xiaomi there. There we go, bottom of your screens. Earnings is also a big theme still. Ping An was out yesterday. Tianqi Lithium was also out. Big drop in the shares in Hong Kong. Big drop in A shares, I should imagine. There we go, 16%. These are A shares you're looking at here. HKX is coming with earnings. Oh, day 2 of the bubble tea maker. We're down 5.8%, 28% drop yesterday. And there's also a trading debut today. In your pre-markets, we were down 20% on Mobvoi. And your initial pricing in the opening minutes, flip the boards please if we can, should be showing you 16%. But although, silver lining, Yvonne, we're coming on below to the day.
Still double digits, though. We'll continue to watch this one as well. And yeah, given the fact that tech is doing so well here today, this is a Chinese AI firm, too, not really playing ball this morning. We're taking a look at these Aussie CPI numbers that just crossed your Bloomberg here. So 3.5% is what we saw for the year-on-year numbers. That's slightly higher than expected, although it is still seeing a bit of a kind of slowing of price pressures in Australia. Keep in mind it was 4.1% in the fourth quarter. So we're getting ever so closer back into the RBA's 2 to 3% target band. And this really bodes well potentially for what's going to go on with that RBA meeting that's set for May 6th and 7th. Maybe that's going to feed into what this means for projections on growth and inflation as well. Though, RBE economist there, James McIntyre, is saying that disinflation that you're seeing, though, has been uneven. If you take a look at how, price pressures on housing rents, for example, insurance costs, for example, as well. There you go. You're still seeing a bit of a lift there when it comes to the Aussie dollar, given that these were stronger than expected. All right. Meanwhile, we're talking a little more about these Chinese markets and what's really driving all this momentum in these markets now. You take a look at how Bloomberg Analysis, they've been looking at China's sovereign wealth fund has likely bought at least $43 billion of onshore ETFs in the first quarter. Let's get to our GDU, or Asia Stocks reporter, joining us now. So we're still seeing quite a bit of state, support in this market.
Yes, exactly. More than 6 times than the amount that the central regime bought in the 6 months through December last year. So essentially, to me, it's a big amount. And when we talk to investors, they were saying that is just maybe just small part of what we can verify, because all the inflows we've checked are only for the ETFs that are the biggest in China. But for the smaller ones, when they are not the top holders, those numbers are not in the filings. So the actual number can be much bigger than we've seen.
I guess the question is, does it continue? And if it doesn't, is that good news as well? Because there's less need, I guess, to support this market.
Yeah, I feel like it is. At least, you saw the UBS upgrade yesterday, upgrading China. Obviously, they put national team as one of the key reasons why they're turning a little bit more bullish, because it is really putting a floor. Not like they're going to boost the stocks, but at least people feel like there could be some support when the stocks are down to a certain point. We've seen some support whenever, the Shanghai Composite fall to around 3,000 level, and we could see some afternoon rally for the onshore stocks.
We were just talking to John Lin from AllianceBernstein about this sort of 9-point, these guidelines and how he really hasn't seen this scrutiny when it comes to, how companies reward shareholders. I mean, in the decade or so. Certainly something that he didn't see 15 years ago. How important is that? And how big of a trend is this?
Yeah, I think that's a very, very interesting topic. People have been watching for a long time, because in Japan and Korea, Korea has the Value Up program, and Japan has all the corporate governance. I think China is just trying to do the same, but it's just how fast they can do it. I think the 9-point guideline announced 2 weeks ago is really, kind of like an inflection point. We've seen some companies in Asia, they have switched their plan to announce more dividends in the past 2 weeks, and also we've seen some CSRC, they're doing a more faster approach to rectify some illegal tradings by some key Asia companies, which are all good signs. So I think in general it's a very welcome move by the investors at this moment.
Jeannie, thank you so much. Our Asia Stocks reporter there. There's a full story, by the way, on this 9-point theme and the scrutiny sparking these holdouts to pivot to giving out more money to shareholders. Right, just ahead, someone's in China. Secretary of State Antony Blinken. He's on the ground. He's set for some difficult conversations there as he visits the country, with Beijing accusing the U.S. of economic coercion and bullying. We'll have the details next. This is Bloomberg.
We can say that the relationship is getting worse. It's true, but it's getting worse quite slowly, and there's more stability to the relationship. But that when there is conflict, the conflict does not escalate out of control. Rather, the escalations are targeted and calibrated.
Ian Bremmer, founder and president of Eurasia Group, speaking with us earlier on shows here. Now, of course, the backdrop here is this relationship, and China's launching its harshest attack yet to date, at least, on U.S. complaints about industrial overcapacity, and really just comes as Antony Blinken, U.S. Secretary of State, is due to arrive. Jenny Marsh is with us here on set, we're the China editor, to talk us through this. And yeah, we know the positions are quite clear as it pertains to this specific issue here of overcapacity.
Exactly. So it's quite unusual for China to hold one of these briefings before the arrival of a dignitary. So it really signals how seriously they're taking this and the sort of message they want to send to the US before Blinken does arrive in China. But overcapacity among the Europeans and the Americans now is like really emerging as one of the big sort of sticking points in the relationship, as these leaders are accusing China of sort of exporting its manufacturing overcapacity to the rest of the world. And we saw, Schultz talking about this earlier this month as well. So it's really going to be one of the big sticking points, along, of course, with, China's continued support for Putin as the war in Ukraine goes into the third year. And Blinken's expected to carry a very strong message, about China's support for Russia's war machine.
We're just talking about this TikTok bill that could get enough votes to really pass in the Senate here right now. I'm just wondering, it seems like China's been quite muted in terms of the response of overcapacity of late. It's been mostly just kind of these statements. But, if there is actually some sort of law to ban or divest TikTok, how likely is Beijing going to respond?
It's going to be it's a direct attack on China if they do go ahead with this and pass it into law, as it looks like. So, the Chinese playbook is tit for tat, it's reciprocity. So they're going to do something to retaliate. The Chinese are very careful, though. They don't like to do things, obviously, that hurt their own economy. And never has that been more true than right now, with the economy looking sort of fragile and Xi really trying to get things going again. The other question, too, is, how do you reciprocate to a TikTok ban? If you hit an American company in China right now, when you've had Xi Jinping coming out for the past sort of year trying to convince foreign investors in San Francisco, as well as earlier this year in China, that actually they're very welcome and they want more of it, it's going to completely undermine that message. So they're kind of walking a high wire here in how they actually can respond to this.
It's almost the news gods listen to us. Breaking news right now out of the U.S. Senate. So the bill has been passed, $95 billion. That's the aid package, Ukraine, Israel, and Taiwan. The red headline just crossing the Bloomberg terminal, as, of course, they are just about to wrap up the voting there on the floor of the U.S. Senate. Jenny, I'll bring you back in. Since we talked about this, why don't we pivot to the EU and this new investigation going into procurement of medical devices along the same lines of protectionism?
Exactly. It's all the same theme, and it's almost like once these blocs and these governments start looking into sort of Chinese overcapacity, protectionism, the rules of the game, it's fanning out to different industries. So now it's to do with medical procurement. And again, like Schultz and Treasury Chief Janet Yellen in Beijing this month have talked about this unfair playing field that their companies experience. Now the EU is this other probe adds to the EV probe they already have ongoing.
That's right.
They're investigating Chinese sort of involvement in wind farms in Europe. So there's this whole sort of battlefield now of industries where the EU is really putting the pressure on China and saying, we don't believe this is fair. And it's really criticizing the entire structure of the Chinese economy, because the way that the Chinese economy works, the government offers subsidies and tax incentives to, industries that it favors. And they have pledged to sort of treat foreign companies like they do national ones. But then, you could argue they don't treat national companies in a particularly sort of predictable way that suggests due process either. Xi Jinping will be going to Europe at the beginning of next month, his first trip to the European Union in 5 years. And so he's all of these things, he's got a lot to talk about when he goes there. And he's picked 3 countries, France, Serbia, and Hungary, which are all seen as being a little bit more friendly towards China, or at least speak with their own voice and don't sort of just speak in line with like the US and the European Commission. So it's a very interesting relationship right now. And for a long time, Europe has been a buffer between the US and China. And it seems to be tracking much more towards the US position, and sort of that puts a lot more pressure on China at a time when its economy is already under so much strain.
Jenny Marsh, our Greater China editor there, with the latest as well. So, of course, to recap, that bill in the Senate did pass when it comes to aid to Ukraine, Israel, as well as Taiwan. But also included in that is, of course, that TikTok sale provision as well. All right, let's move on to talk a little bit more about the South China Sea and the like. Southeast Asian nations have long eyed tapping the energy riches of that area to help grow their economies. But a fleet of Chinese fishing boats and a giant vessel dubbed the Monster are making sure that won't happen anytime soon. That is the subject of today's Big Take. And for more, let's bring in our Southeast Asia government reporter, Philip Hyman. He's in Singapore for us. Philip, a very interesting story here about how you think Xi's fleet is winning in the South China fight when it comes to energy. Tell us more. Why?
Well, you know, we've seen over the last several months tensions flaring between the Philippines and China, of course, over an area that's rightly is called the Second Thomas Shoal. There, of course, I'm sure, you know, all of our viewers would have seen footage of water cannons and so forth and near collisions, in fact, actual collisions between Chinese and Philippine ships. But at the same time, there are, of course, economic resources at stake. We're talking about, of course, trillions of cubic feet of natural gas, billions of barrels of untapped oil reserve in the South China Sea that for years a lot of these Southeast Asian countries would love to kind of get their hands on, but has been prevented from doing so because China has established a very strong militia, very strong Coast Guard fleets, and has kind of blocked access to those.
Right, Philip. Remind our viewers what's at stake here. What's the big picture?
Well, you look at the current situation, of course, tensions are riding high. This kind of, we have the U.S.-backed, we have a U.S. alliance in the Philippines. We have a very assertive Chinese posture. And now we have Manila in between trying to more assertively take a stronger stance on China's claims in the South China Sea, which were, of course, ruled baseless by a UN tribunal back in 2016. How does this play out? Of course, you know, history shows us that there have been clashes, violent clashes, deadly clashes, in fact, between competing ships in the South China Sea. In the future, of course, you know, nobody wants another conflict. We already see one happening in Ukraine. We already see one happening in Israel. And of course, you know, there's a growing anxiety amongst Southeast Asian nations that what's happening in the South China Sea could spark another such conflict. So, you know, but with regards to oil and gas reserves, this is something that is very important for nations like the Philippines, for Vietnam, the Philippines, of course, has an emerging energy crisis. It desperately needs to tap those energy supplies. President Ferdinand Marcos has talked about the need to do so urgently. So have his lieutenants. This is something that we're going to start seeing more assertive posturing happening in the near future.
It seems like it's interesting, right, that there's so much news around this area. I mean, we thought last year maybe Taiwan could be one of the most kind of dangerous places to really look at. But now we're really focused on Southeast Asia and the South China Sea in particular. Is this sort of the new sort of arena, I guess, where we're going to see tensions flare up?
I wouldn't discount tensions over Taiwan at any point, but you know, I would say there's absolutely those rising anxieties within Southeast Asia. We are starting to see militaries across the region establishing, spending more money, reinvesting in their own military modernization programs. In fact, I just think this week Singapore got its 4th Invincible-class submarine from Germany, and the officials are there at the moment. There is a sense that nations here need to really be ready, even if they are non-aligned, even if they're not with the U.S. specifically or with China specifically. The chances of a potential conflict could force them to adapt a more defensive posture.
Right, Philip, thank you. Philip Hyman there, our Southeast Asia government reporter, and more, by the way, on today's Big Take. You can check that out, longer form. Subscribers can head to the terminal, NI Big Take Go on your Bloomberg. On the website, it's on Bloomberg.com. Speaking of geopolitics and more on the breaking news a few minutes back here in the U.S., Senate passing this bill here. So U.S. President Joe Biden, White House out with a statement. and they'll be signing this bill into law on Wednesday. Just talking about certainly the urgency of this, given the many fronts, of course, that this bill tries to address.
I mean, they bundled it all up in one, right? Yeah. Which is interesting that we kind of have to highlight, in particular, the TikTok sort of implications, because we've heard that the company is willing to fight this out in a long, prolonged legal battle. Because in one way, you know, we talked about 170 million users that are at stake here right now. So the company thinks in that part, you know, they have a defense here that, you know, you could argue the freedom of speech sort of argument here and possibly have a chance of winning it. But certainly, you know, this is going to go on for some time, I believe. It's just not over just yet.
No, we haven't. No, we're just beginning, in fact.
Yeah.
This new chapter on this specific issue. We'll bring you all the latest out of this national security package. Of course, President Biden will be signing this into law on Wednesday. 18 minutes back, also some breaking. Well, it's been busy this hour. Inflation out of Australia on this longer, higher for longer narrative. We thought we forgot about it for a few days. And this print just reminded us, nope, I'm still here. 1% on inflation at the highest end of forecast. Markets are reacting. Aussie equities are now flat. We're higher earlier on. Aussie dollars on a rocket, as with your yields over there in Australia. Plenty more ahead. This is Bloomberg.
I just want to recap the breaking news here of course, the U.S. Senate approving that bill that is an aid package to Ukraine, Israel, Taiwan. Also, part of that is that TikTok sale provision. So certainly we're hearing from the Senate Majority Leader Chuck Schumer briefing the media at this evening in D.C. We've also already heard from Zelensky of Ukraine, you know, saying that he's grateful to the U.S. Senate for approving that aid package to the country. So we'll see if we hear any more about the TikTok side of things as well. But President Biden has said he will sign that aid bill into law tomorrow.
Yeah, and the weapons are also headed to Ukraine.
Yeah.
This week. There we go. Back here in Hong Kong. Hong Kong is set to follow in the footsteps, and we're talking cryptos and ETFs here, of the U.S. Here, listing a batch of cryptocurrency ETFs. For more on this story right now, and of course it could come in the next few days. We'll see. Subhash Ghosh, our Asia Finance reporter, is with us right now. I guess the question is it will obviously help Hong Kong, but how will it help? Also, given the fact that in the U.S., for example, some of the flows into those Bitcoin spot ETFs arguably have cornered the bulk of the market already.
Yes, you're right, David. So what has happened is Hong Kong has, one of the advantages that Hong Kong has in Asia is that this is a first mover advantage, because Hong Kong is the first in Asia to allow the spot Bitcoin and Ether ETFs. So Ether is actually globally the first in Hong Kong. So this is the very big advantage for Hong Kong, because in Asia there are several investors, a lot of investors, institutions who have been seeking to invest in these spot Bitcoin and ETF funds, but then they were not getting an access because it's all the way they have to go to the US to do that. I mean, they have to invest in the US to do that. Now that field is open for them to do so in Hong Kong, in the same time zone in Asia. So that's a big advantage when it comes to issuing these and allowing this to be traded in Hong Kong. That's one of the big advantages over here. But to kind of also add to your second part of the question about how will this be as big as the U.S. market? I think that obviously U.S. has the deepest ETF markets globally, and the big names like the BlackRock and the Fidelities, as we know, are leading the Bitcoin spot Bitcoin ETFs in the U.S. So in the absence of these big names in Hong Kong, it could be a little less. I mean, it could be actually a fraction of what US is seeing in terms of the size, the flows of the market. But it is nevertheless a big and important step by Hong Kong, which wants to be, a digital hub in Asia. So that's a very important. This is an important move in that respect.
Yeah, I mean, as you mentioned, right, some of these prospective issuers, Harvest, China Asset Management, not really the same in terms of recognition as maybe a BlackRock, so we might not have that effect here in Hong Kong. Subhash, thank you, our Asia Finance reporter, Subhash Ghosh there, joining us in Singapore on what's really going on here in Hong Kong. We're taking you to, of course, more. If you want to read more on the city, to our, of course, insider's guide to the money and people shaking up our finance hub in the new Hong Kong edition newsletter that's out every Thursday. You can sign up through the website, bloomberg.com/newsletters. Looking at markets here right now, it's really these trading debuts that we're tracking this week that continue to be, yes, pretty ugly. Mobvoi is the one today. This is, of course, the Chinese AI firm that's backed by Google. That's down some 19%, despite tech really catching a massive bid this week in HS Tech. At least Tianjin Construction's doing a little bit better for day two.
Yeah, rebound today. Also coming in unexpectedly is this hot CPI print out of Australia here. So 1% Q-on-Q. That's the market reaction so far. Yeah, there's lots of stories to tell you about in the next hour. Of course, keep it here. You're watching Bloomberg.
Welcome back to the China Show. Here's a look at Hang Seng just a half hour into the session. It really is kind of the top of the world. If you take a look at how its performance has been this week, we're up for a third straight day. I think we're seeing gains about already 5% so far in just the last 3 days or so. So certainly there is a rally underway. Shares gaining another 1%. Dave.
And we're now looking at, I'm just looking at live data here. So 18 straight days now on net inflows into Hong Kong from mainland China. So net buyers continuing, and in fact turnover has been also picking up there as well. We'll talk about that later. Broadly speaking, though, Asia is also feeling the tailwind, by the way, coming off a very good session on Wall Street overnight. On top of that, after the close, you had the Tesla story coming out, and of course on top of all of that, then you're also getting US futures pushing higher, a third of 1%. So overall, we're better by 1.5%. Most markets are on the way up, 2% on the Nikkei 225. By the way, we haven't even talked about dollar-yen closing in at 155, right?
Yeah.
Euro-dollar on your screens looks to be broad-based across markets, across sectors. Two-year yields pushing low right now. What's standing out, though, and one of it is on this board, should be on your next board as well, Aussie assets reacting quite badly to that hot CPI print 30 minutes back. So Aussie equity markets have just about erased, and then we're coming off a little bit lows right now, 0.25%. Aussie dollars on a stronger footing, and we're up 14 basis points on your Aussie 3-year yield.
Yep. From where, let's bring in our Bloomberg MLI strategist, Mary Nicola. Mary, it seems like big tech's in the hot seat, really, and it's really helping to lift the mood here in Asia. Do you think we can last for the rest of the week like this?
Yeah, it really all depends on earnings. So we're going to have a few companies coming through over the next few days, and we'll hear from how good their earnings are, how good the outlook is as well, because it looked like overnight, even though Tesla's earnings were bad, the market was still looking for an excuse to rally. So especially after such a bad week, any silver lining that they could find, in terms of Tesla looking at cheaper models or potentially focusing on AI, but they're looking for some reason to rally, and earnings will be the key trigger.
Speaking of triggers, something seems to be brewing, and we've been here before to caveat here in these Chinese markets where you're getting periodic rallies within a bear market. How are you thinking about China these days, Mary, particularly given the outperformance we've seen here in Hong Kong this week?
Yeah, it's interesting with China, because what you're looking for still is some sort of fundamental support to really drive this rally. And so far, we haven't gotten much there. Whether we're looking for on the consumer side, and some of the data has been disappointing to say the least, we still have deflation. So it's hard to get very excited from a fundamental perspective. But obviously, the last few weeks the trend has been more of your friend when it comes to some of the equity markets in some days, right? But it's been more intermittent than a real strong rally. I think where where it lies is really what we've seen in bonds. And China bonds have been quite resilient, and they've been the pillar of strength in terms of where we've seen the rally move. And I think there's still potential upside there, because if we're going to see, if there's a deflation persisting, that's still going to be supportive for bonds going forward.
And Mary, I mean, we're really focused on tech, obviously, this week, but it seems like we pushed away the Fed story for now, but I take a look at that Aussie CPI print that came through, where inflation is easing, but still this disinflation sort of trend seems to be stalling in Australia as well, not just the U.S. also. We're seeing these yields spike now. I mean, this higher for longer scenario is really playing out here in some parts of this region, too.
Yeah, absolutely. So now it's not only the Fed, it's the RBA, and almost like what's next? Well, one thing we have seen is the Eurozone seems on the trend of going in the direction of disinflation. Of course, the elevated oil prices that we've seen over the last month or so hasn't been very helpful. And that can trickle through. But if you look at things like Australia, like the US, their economy's been holding up, which has been quite surprising, especially given how high rates are. So it puts a lot of these central banks in a predicament where, at least for the US, growth has been resilient, but for Australia, it's been a little bit wary in terms of some of the data hasn't been as strong as, let's say, in comparison to the US, and puts the RBA in a difficult position. But at the end of the day, they're an inflation targeting central bank, and whatever inflation tells them, that's what they're going to do. So that's one of the reasons why you see the swap markets now pricing in less than a 50% chance of a cut even this year. And of course, the inflation volatility is going to be absolutely crucial, which just means that the focus is still on data dependency.
Mary, thank you. Mary Nicola in Singapore for us, out of our MLive team for our clients. All the work there, of course, on MLIV Go, on your Bloomberg terminal. Right. Speaking of these Chinese markets, we're about 44 minutes into the cash market session. This bullish break so far has been holding. We're talking about the Hang Seng China Index. We closed above that level yesterday on, I think it's the 200-day moving average. So far, we're holding above that specific level right now. The next line in the sand perhaps would be, and these are very close levels to watch, right? The 200 and the 6,000 level, almost the same. We're back to the highest levels almost at the start of the day, since the start of the year. So want to watch, certainly. We're currently trading 12 points above that 6,000 level. So this part of the Chinese asset world has been doing well. Also onshore, fixed income has done also quite well here.
Yeah, I mean, take a look at the borrowing costs there. They're basically at record lows here right now. We talk really about, all this sort of yield pickup, or people searching for yield in the bond markets, and you're certainly seeing that in the local credit markets. So we're talking about these onshore 3-year AAA corporate bond yields. They're falling to a record low. So certainly there has been a lot of buying into some of these credit markets here of late. And of course, we still got to talk about Tesla.
Yeah, a 13% move up in after-hours trade. That's leading to this next graphic you're about to see on your screens. U.S. futures pushing even higher. So that's, I think, your first key hurdle as far as this year's earnings story is concerned. Not to mention, a lot of other big tech companies are reporting earnings the next few days or so. Although I'm looking through the next few weeks, I'm looking at NVIDIA in about a month from now. We could talk about that next time, though. Tesla speeding up the launch of cheaper cars after reporting earnings that actually missed estimates. Beth Kindig joins us now, lead tech analyst at Tech Portfolio IO Fund. Beth, as always, a pleasure to have you show, and we're looking forward to getting your insights on this. Start with Tesla. Why not? Cheaper models. Do you think they'll do it? How big of a game changer would that be as far as the company's financials are concerned?
Hi, David. Good to see you again. It will certainly drive, number of vehicles, deliveries, and things of that sort. What is being pointed out, and it's very important to realize, is that it could continue to weigh on margins because if a lower price is going to lower the margins. Well, the margins are already walking a very thin line right now. Even though there's a $25,000 vehicle rumored, as you likely know, BYD has one that is as low as $11,000. So will it solve the problem that Tesla faces, which is that in China, they're losing market share? It may not solve that problem. The problem it could solve, which is quite important, is that the United States has been facing high interest rates for a long time. A lot of people want to look at Tesla stock as a Elon Musk problem. It's not. It's an interest rate problem. That's why we see the same issues around Apple right now, struggling to keep up with being a high-priced device. And overall, a lower-priced vehicle in the United States could certainly help spark some new sales. Again, the margins would likely continue to remain an issue in that case.
Can you tell us a bit more about what they can do in China? I think it was Evercore yesterday that said, they can't really afford to keep slashing these prices because this is really going to wipe out their earnings in the mainland. Do you think the market is properly pricing that sort of scenario?
Yes, it's definitely the bigger deal because you're not going to be able to replace that anytime soon. However, as AI approaches, that's the piece that Tesla's going to have to execute on. So what we're seeing is a moment where it's a little too early for AI software. As you know, AI hardware has been a huge boom with H100 moment last year from NVIDIA. But AI software, we're not in that cycle right now. And that's what Tesla really, truly needs in order for its stock to resume where it was before the Wall Street darling. And that AI software cycle, if I were to give you my best estimate, would be more of a 2026 discussion. So between now and then, they have a China problem. And how they solve that China problem will not be an easy answer for Tesla.
So, Beth, you mentioned if rates are the main culprit why margins have, well, multiples, not margins, why multiples have compressed and the stock is down, what will be the best determinant whether or not the stock has bottomed as well? Do I look at rates or do I look at margins?
Those two will move together because they have to continue to lower average sales prices to keep up with the higher cost of the vehicle to the consumer. Obviously, the rates make the vehicle more money per month to the consumer. So those two will be in sync. The minute those margins bottom, though, or the minute we start to get a more dovish Fed, this is going to be an excellent buy. This stock is deeply on sale. It's very rare that I can look at a Mag 7 stock that is deeply discounted in the way that Tesla is. If this thing continues to go lower, it's an attractive entry eventually, because this company's not going to go out of business. They're an AI leader if you're patient enough. And all of those come together to don't get too cold, ice cold on a stock like Tesla, which is arguably one of the better top 10 stocks in the market.
So certainly there's more room for improvement here. I'm just wondering, given what you're seeing in the Mag 7 right now, it seems like Tesla's the weakest link. Where else are you looking for, in terms of AI contributions to revenue or even CapEx outlook for AI? What stands out to you among the 7 now?
Yes, I would say Microsoft is a very big report this week. This has always been known as the cloud bellwether. It is now the AI bellwether. And the reason why AI continues to be very important is that this is where the real growth is happening if you look at certain pockets. Outside of that, we're seeing a lot of deceleration if you look very closely. So we want to see Microsoft continue to do what it did before. 2 quarters ago, AI had a 3-point contribution to Azure. 1 quarter ago, it had a 6-point, so it doubled. We're talking about $75 billion segment. If we continue to see that ramping up, I think the market will be very excited to see that from the enterprise segment, from enterprise companies. And then, of course, when it comes to big tech CapEx, Tesla's report could not have been more bullish in terms of the H100 equivalents and how they grew those 130%. Across the board, big tech has those big pockets and is fueling a lot of this growth cycle that we're in terms of AI.
Right. Others reporting this week, and apologies if we're going through one after the other. I mean, there's just so much happening this week. Beth, Meta, how are you thinking about this?
Meta is a very, very interesting stock because, as you know, last year it was known for the year of efficiency. They really tightened their belt. Margins expanded, greatly expanded. What we want to look for right now is, will Meta become a full-fledged AI stock? This will be shown in the average revenue per user. We're already seeing this phenomenal rebound. It was only 2.5% growth last year, this quarter, and it's going to be 25%, especially in the United States and Canada. So they're basically using AI to greatly improve their average revenue per user. Eventually, Meta will become a full-fledged AI stock. When that moment happens, it could be quite bullish. Since ad tech is so incredibly cash efficient, you have that perfect combination where Tesla, with high interest rates, gets kind of kicked out of the Mag 7. Those with those large cash reserves, high free cash flow margins that could only potentially get better with AI, will be greatly rewarded in the current environment we have with interest rates.
What about the impact on AI on Alphabet? I know they've come through with their AI strategy, but they basically have monopolized the search side of things. I mean, does the emergence of ChatGPT change that in any way? I know they fended off multiple threats in the past before. Is this time any different?
Yeah, so what we're seeing is even if search puts up a decent growth, the market is not convinced that AI is driving that. And if AI is not driving that due to lack of engagement on their AI products, then they just have many, many competitors on their heels. And we're talking obviously OpenAI, but there's a lot in the private markets that is happening right now too. So you'll see the market a touch nervous until you see that direct impact. And also on Alphabet, I would add, until Google Cloud starts to be very, very consistent in the way that Azure has been, and Azure re-accelerated over the last quarter, that's the other thing the market will want to see. If you're truly having an AI impact, you should accelerate from here. It should be consistent, and it can be quite lumpy. So until that smooths out, right now, Alphabet will eventually, again, be an AI player, but the timing is more difficult to predict because it's been lumpy. They've went from being a leader to now a laggard in terms of AI capabilities.
So Beth, all this being said and other things still, on the table right now, and given the drop we've seen over the last few weeks or so, tell us how you've been managing your exposure. What have you been adding the most? What have you been reducing? What are you excited about going into these other earnings reports, of course, too?
Yes, we continue to accumulate semiconductors at lower prices. As you know, last week was brutal for certain stocks, NVIDIA, of course, but there's other AI accelerators and companies that are contributing to AI data center. If we can get those at lower levels, we'll gladly take it. So we have been trimming any area that's not a semiconductor AI data center beneficiary and doubling down on those. You have many competitors to NVIDIA coming online right now. When I say many, I'm talking more around AMD, and then you have Broadcom, which is more in the custom silicon market. And then we also have this memory battle that's going on right now where AI accelerators are competing on memory, not computing power. That's very key to understand how 2024 will unfold. So there's some memory beneficiaries as well that are important. And I'm sure you talk about it on your program as well from South Korea. The United States happens to have Micron, and then there's equipment suppliers for the memory. There's a lot of stocks to look at in the AI data center, NVIDIA being the bellwether, but there's a few you can look at, and we are doubling down on those.
Beth, always great to have you. Beth Kindig, their lead tech analyst at AO Fund, joining us from Boulder, Colorado here. I'm taking a look at what's going on when it comes to SenseTime. So speaking of AI, so it seems like this company, which really has been, was a pioneer when it comes to AI in China, they're launching a new AI model now. So we're seeing the shares really flying here, gaining double digits on the launch of this new AI model. We're seeing if there's any more details on it, but there you go. Stock up close to 30%, Dave.
There we go. Also flying right now, yields over in Australia, short-dated yields, three-year bond yields specifically, up the most since June of last year on that CPI beats. We're up 13, 14 basis points on that. Aussie dollars on a tear. And we're seeing a little bit of weakness coming through in the equity markets. Are we going to show the Aussie 10-year yield? Why not? Why not? Anyway, maybe later. Maybe later. All right, just ahead. Why the slump in the Indonesian currency may keep the Bank Indonesia rate decision, of course, later today from cutting rates for now. That's next. This is Bloomberg.
All right, you take a look when it comes to Aussie assets as promised, and there you go, 17 basis point spike when it comes to that three-year yield here this morning. This is on the back of that CPI that came in better than expected at 3.5%. So that actually, does it change the calculus for the RBA when they meet next month? And you're seeing 13 basis points higher for your Aussie 10-year yield. That brings us back to levels that we've seen, back in June, wasn't it?
Yeah, biggest jump since then. It gives us something to think about, really.
Yeah.
Inflation story, right?
And then you got to wonder what, the impact on currencies, obviously, just given the dollar's strength.
Yeah.
And, front and center is really what's going on in the rupiah, right? Where we've come off some of the lows, but we're still talking about a rupiah that's been down some 5% so far this year and really coming to the range of the pandemic lows here right now. And maybe that's why today, BI, there's a hint, maybe a slight pivot, maybe, to a hike.
Yeah,
something.
a bit of a hawkish tone. With this exchange rate, maybe we should all pack our bags and visit Claire Zhao, who's in Jakarta for us at 16,000 the exchange rate. That's hard to argue with. Claire, I'll bring you in. Of course, Claire covers Indonesia's economy for us as well as Southeast Asia. Claire, well, what are the chances of an actual hike, or what the statement might look like, given all the complications around inflation, the weak currency, what have you?
I think what we can expect today out of Bank Indonesia is for the decision to come down to the wire. The central question for policymakers will be, is the rupiah weakness going to be persistent, or does it look like it's going to wane anytime soon? Because if we look at the rupiah, as you mentioned, it has been recovering and stabilizing a little bit this week, although it did have a very big drop last week, and it's still Asia's worst performing currency this month. So for Bank Indonesia, they'll want to see if it's persistent. They'll want to act fast and act now before it weakens further. However, there is a sense that cooler heads may prevail for today, and Bank Indonesia may opt instead to hold the rate at 6% and instead dial up its hawkish tone and say, we'll ramp up the interventions in the spot, deliverables, and bond markets, will raise yields to lure inflows, and instead opt to run down its foreign exchange reserves while waiting to see how these global events pan out in the Federal Reserve and the Middle East.
Yeah, and it seems like, when it comes to what we've been seeing, this tightening cycle from Bank Indonesia, it really wasn't about taming inflation per se. It was really about FX stability. So how low is that bar now to actually hike?
Yeah, we've seen this dilemma across all emerging Asian central banks. They're being squeezed between their currencies and the Federal Reserve, and that pressure is more acute for Bank Indonesia, where its prime mandate is currency stability, and it has knock-on effects on inflation as well, because we rely on imports for food and fuel. However, Bank Indonesia has the benefit of hindsight this time around. In October, if you recall, it surprised markets with a rate hike after the Hamas-Israel war. What it ended up doing during that time, though, was it ended up spurring more outflows as investors viewed this as some sort of panic hike. So Bank Indonesia will want to avoid any sense that it's nervous and it's panicking in the wake of this volatility. So what it might end up doing is say, we'll calm the markets, we'll wait for things to calm down, we'll rest on interventions for now, and hold the BI rate.
All right, Claire Zhao, thank you, our Indonesia economy reporter, on what to expect out of the central bank later on today. We got plenty more ahead. This is Bloomberg. All right, it is a day 3 of just momentum and just this rally continuing when it comes to Hang Seng as well as the 8-share market. We're up 1.5%. You take a look at what's really driving this, and one stock in particular we just talked about, which was SenseTime. Yep. That's really lifting this benchmark and announcing this new AI model, and that's sending the shares, double digits gains this morning. Yeah, and that's really helping this, as you point out, of course, gaining as well. I think we're up 28%. Let me just double check where we are right now as far as the stock is concerned. Quite substantial, to say the least. Almost the opposite, in fact, the opposite of what the next stock you're seeing on your screens did yesterday, which is the bubble tea maker Chow Bai Dao, fell 28%, fell as much as 40% in the first day of trade. It's continuing to fall 7%. The debut today's Mobvoi, which is an AI play as well. A ChatGPT rival, apparently. Yeah, 17% down. Tianjin Construction, which debuted yesterday, not as good. It's pairing some of the gains. At least it's up now. Some of the other things we're tracking here, lithium, Tianqi Lithium out with earnings. You had a loss there. That stock is down. A and 8-share market. EVs and also Xiaomi's actually also seeing a nice gain. Citi's out, raising the price target on Xiaomi. I guess on the back of the CEO talking about how the margins are going to look like for this new model. I mean, it's an EV stock now, it seems. But yeah, on the lithium, on that winding loss, we're down some 6%. We got plenty more to come. This is Bloomberg. Bordeaux. All right, 11:29 a.m. in Tokyo right now. Japanese market's heading into that lunch break, and yeah, They're pretty happy, right? Take a look at that. 2% gains to the Nikkei 225. We're not even talking about dollar yen here right now. I think we're still around those intervention levels and getting very close to 155. Yesterday, when we heard from Suzuki-san, that was the clearest sign yet. People say strongest sign, at least, from officials that they may be ready to intervene. But, no news yet. We'll bring you the latest, of course, if they do.
The rest of the region doing this, so 2% in Japan, as Yvonne is pointing out. We're also doing quite well on a regional basis. And a lot of this also has to do with the fact that Hong Kong is doing very, very well. We're up 1.5% in the benchmark. U.S. futures are also pushing higher as well. And nearly everywhere you look, at least on this specific graphic, is showing you some green. Strength in Asian FX. Most, if not all, major sector groups are higher. IT's up 3.4%. That's really down to the move in cents time. And 10 cents actually doing quite well again about an hour into the session. Asia ex-Japan also better by 1.5%.
All right, let's talk a little bit more about bonds. I mean, we've exhausted the tech discussion today.
Why don't we talk about the Fed? We never talk about the Fed.
It's been a while. We missed it. Our next guest made a call last year that the Fed will not cut until after the U.S. election in November. Let's see what Gordon Tsui thinks now, Managing Director and Head of Fixed Income at Ping An of China Asset Management Hong Kong. You must feel vindicated, Gordon, that the market is finally caught up to what you said as early as last September when we thought you were nuts.
Thanks for the cue.
Do you still feel that this view sticks?
I still follow this view. In fact, U.S. inflation has become more sticky at the moment compared to last time in September. And core CPI change was 3.8% year-on-year. 2 weeks ago when you announced, the whole yield curve plunged, surged 20 basis points across, from the short end up to 30-year, and it caused significant pressure on risky assets as well. And in fact, I think bond investors reckoned that the Fed policy stance actually could unlikely turn dogfish when the economy is so resilient. And also, inflation numbers are still quite a distance away from the Fed's 2% target, even though it's the core PCE, in fact, not the headline CPI or the core CPI. But after all, from Bloomberg's own ECFC, the economic forecast function, in fact, core PCE year-on-year will edge down to 2.3% in first quarter next year. But still, before the elections, there is no way for the Fed to turn dogfish.
And I guess to address the premise, is that because inflation's been sticky, or is there a political element to that call on no cuts before November?
I will say right now, in fact, the real interest rates, if we look at all these nominal inflation expectations and real rates, in fact, I will say the monetary policy is about right. Because the U.S. real interest rates across the whole yield curve, they are positive. Looking at the short end, if you consider the nominal overnight Fed funds rate at 5.3%, deducting the headline CPI, in fact, it is still 1.8% in real rate term. So depositors are actually making money. They are increased. They have their purchasing power is growing just by parking in some interest risk-free money market rate. And money market funds. So if that's the case, why take the risk? Nasdaq, the NVIDIA can plunge 10% in one day, right? So in fact, this is already
sucking on NVIDIA.
Picking on stocks.
Yeah. But I'm bullish on this stock anyway, the AI, because...
Okay, look at you hedging now.
So what does it mean for Treasury yields and the direction of travel now?
Right.
I mean, it seems like 5% was sort of a ceiling. Can it break above that? Or is that when you start to see more of your clients say, I need to lock in these yields at these levels?
When we look at this kind of a benchmark of the benchmark, my favorite strategy is that, Ian Ning, he's from BMO, he quote this term. And in fact, if you look at 10-year, for example, basically it reflects the trajectory of Fed policy, in the medium term, how low, how the trough of these overnight funds can reach. And also in the interim, the demand-supply dynamics of the U.S. Treasuries is also a key determinant. And when we look at November's quarterly refunding announcement by the Janet Yellen, they actually shifted the balance of the market The tone went from going up to 5%, testing even higher, back down to as low as 3.8% in late December. So this supply-demand dynamics in the short term can make the market deviate from the central kind of tendency, which I reckon 4 to 4.5%. And in this episode, I don't think 5% is such a big, I don't think it will reach that kind of level this time. Because in fact, monetary policy, it is actually working. It is in fact quite restrictive. And James Bullard, the retired St. Louis Fed president, he was actually in Hong Kong 2 weeks ago, in also that conference. And I met him in person, and in fact, he's advocating that interest rates should go down just so that the policy stance is not so restrictive. Otherwise, there will be a more significant downturn in the roads ahead. But personally, I do not buy this view, because actually, apart from the fiscal generosity that people have already mentioned, fiscal largest, I think there is also an additional kind of factor coming into play. It's the industrial policy, the supply chain diversification, and all of this will add cost pressure in traded goods prices down the road.
So that keeps rates, at least the low on the next cycle, higher than the last cycle. How are you thinking about duration at this point in time?
Last time, I advocate just parking the short end, meaning 2 years or less. In fact, it can benefit from that November, December kind of plunge, as the market was pricing in at its extreme as a 150 basis point at one point. And on the other hand, in fact, in this time of when interest rates are moving higher from in the 10-year, 3.8 up to now 4.6. It's actually very defensive. Not much mark-to-market losses. So 2 years or less is still the time to advocate to just park in this short end. And in fact, in an 18-month time frame, even though I'm still saying that the November elections, before that, no Fed move. But down the road, when the PCE numbers are becoming more friendly, in fact, the Fed will really like to loosen a bit, down not as restrictive as currently. And it's just what those senior, Fed officials are still saying.
So you said in terms of strategy, focus on the short end. You don't think the long end is going to move too much from here on?
I think the long end will cause some mark-to-market pains from time to time. So, for example, I don't think Janet Yellen will suddenly shift gear again and increase the long end supply, at least before the election. Okay. But who knows whether Trump or Biden, their Treasury Secretary, may have a different stance.
Right.
So I don't want to take the risk.
Okay. Gordon, it's nice to see you.
Yeah.
You've been right so far. Let's hope you
come back in a few months and we'll talk more.
Let's talk in November or even before that. Gordon Tsui there, MD, Head of Fixed Income, Ping An of China Asset Management, Hong Kong. Okay, just ahead, why tensions in the South China Sea could impact economic development of some Southeast Asian countries. A proper in-depth look is coming up next. This is Bloomberg.
Well, the U.S. Senate has voted to ban TikTok's ownership by Chinese company ByteDance. The measure, which also includes aid to Ukraine, Israel, and Taiwan, won sweeping bipartisan approval. Now, lawmakers are worried about the app's collection of data from more than 170 million American users, as well as its potential for propaganda purposes. The bill now goes to President Biden's desk to be signed into law.
Now, as territorial tensions simmer, and certainly the bigger theme here still, and we're talking about the South China Sea here, China's Coast Guard has been accused of harassing supply boats heading to a Philippine military outpost. And the latest incident that took place back in March was actually the 6th such incident in 8 months. Now, Bloomberg Originals has been looking at why tensions are escalating in these specific waters and why Beijing and how Beijing's actions are heightening the risk of a confrontation with the U.S.
These two ships are from the Chinese Coast Guard. And the ship they're targeting with high-powered water cannons is a Philippine supply vessel.
We've been here for almost 3 hours, and the situation has gotten more tense.
An international court says the Philippines has the right to extract resources in these waters.
Since the threat has grown, we must do more to defend our territory.
China doesn't see it that way.
面对非方船只的强行冲闯，中国海警不得不采取必要的执法措施。
It's the 6th time in 8 months this kind of incident has happened, and it's a growing problem for the world.
The Philippines is an ally of the United States. Second Thomas Shoal is the most dangerous flashpoint today between the United States and China. This is truly a crisis waiting to happen.
China and the Philippines have wrangled over control of these waters for decades. But in the past year, tensions are close to the highest they've ever been. Why?
We are on board the Philippine Coast Guard ship in the middle of the South China Sea, and this is the closest we've ever been to a Chinese Coast Guard vessel. It seems to be blocking our way.
Philippine President Ferdinand Marcos Jr. is keen for more journalists to see the increasingly fractious confrontations with Chinese vessels. The Philippine Coast Guard vessel was escorting this green boat to Second Thomas Shoal. It was a routine mission to rotate and resupply troops on this rusty ship from the World War II era that's been stationed there since 1999.
A grounded ship known as the Sierra Madre has become a de facto base for the Philippines, who use it as an outpost to protect its own sovereignty.
This shoal has also been the area of much tensions over the past months. There have been reports of clashes and water cannoning against Philippine boats even before we came in there.
Second Thomas Shoal is part of the many reefs and shoals in the Spratly Islands, which are much closer to the Philippines in the South China Sea than China. The waterway encompasses 1.4 million square miles, larger than the Mediterranean. Much of the sea is disputed. China, Vietnam, Malaysia, Brunei, the Philippines, and Taiwan all claim specific land features.
It's a thriving fishing zone, yielding some 10% of global catch and a vast amount of trade transits through. In 2016, that amounted to some $3 trillion, including more than 30% of the global maritime crude oil trade. Critically, it also holds very promising oil and gas deposits, something that each of the claimant nations would love to get their hands on in the coming years.
If the Philippines can extract these resources, it could be a real benefit, as the gas field that supplies 20% of the Philippine main island's power is forecast to be depleted within the next 3 years. But here's the catch. China claims the biggest patch of the South China Sea, making it difficult for the Philippines to tap into these reserves. China asserts this area is a part of its territory, citing a map from 1947. In 2016, a UN-backed court ruled that China's claim of historic rights was unlawful, and the Philippines has the sovereign right to extract resources like fish and oil.
China, of course, rejects the ruling outright, but until now, the Philippines has had a very difficult time to enforce the ruling, even though it was in its favor. It doesn't quite have the military capacity to enforce those rules. UNCLOS itself doesn't have the ability to enforce.
It's not just fishing and energy. These waters hold military and strategic value for all of the area's claimants, and crucially, the U.S.
Maintaining freedom of navigation is a global interest for the United States, and it is important in the South China Sea. But there's also other interests, I think, that the United States has, and that is international law of protecting the ability of countries to really exercise sovereignty. And for these smaller countries that are claimants in the South China Sea, their livelihood for many of their people depend on those resources.
So China wants to assert its sovereignty and deny U.S. military access in the region. From reefs and corals to military bases, this is what it's been building in the last decade.
Over time, we're seeing the establishment of airstrips, of listening posts, of refueling stations so that China can send its vessels to those islands and to be able to better patrol much of the greater South China Sea.
Today, Chinese operate Navy ships, Coast Guard vessels, maritime militia 24/7 around virtually every feature that is disputed.
From the beginning of our first sighting of the Chinese Navy vessel, we were with Chinese vessels the whole time. Even when we were going back to the mainland, Chinese vessels were following us. I felt like we were constantly being watched.
This is Tsui Island. Here, the Marcos government is rushing to develop the land so it can try to hold its own against the threat from China. But this has resulted in tensions nearby. Things haven't always been so heated. Remember that ruling that gave the Philippines rights to resources? Former President Rodrigo Duterte said he didn't want to risk a war by trying to enforce that decision. So he decided to seek better ties with China over the U.S.
His presidency was a real test for the U.S.-Philippine alliance.
He rolled out the Build, Build, Build program, trying to draw in more investment for infrastructure projects, including from China. Chinese loans and grants to the Philippines jumped from $1.6 million in 2016 to $621 million in 2020.
A lot of those projects, whether they be from the Belt and Road Initiative or otherwise, never materialized.
In the last few years of his presidency, Duterte softened his view on the U.S., once again allowing joint military exercises to take place. In comes Marcos in 2022, and relations with the U.S. got even warmer.
Marcos has embraced a much more assertive posture in the South China Sea.
A big part of his strategy is transparency.
I think the trip managed to somewhat expose China's aggressive actions in the South China Sea.
China has maintained its actions are legitimate.
中方在南海的有关活动合理合法，无可非议。
A year into his presidency, Marcos gave the U.S. access to 4 additional military sites. 3 of these locations are close to Taiwan, a self-ruled democracy that China considers its own and has vowed to take by force if necessary.
Taiwan is always nervous about whether the United States would come to its aid in the event that China tried to seize Taiwan by force. If the Philippines were to get caught in a hot conflict with China, and the United States responds, as I believe that it would, and come to the Philippines' aid, I think that that would increase the confidence of U.S. allies all around the world.
The U.S. and the Philippines have a mutual defense treaty dating back to 1951. And the circumstances that may trigger U.S. involvement have become more clear recently.
If any serviceman, Filipino serviceman, is killed by an attack from any foreign power, then that is time to invoke the Mutual Defense Treaty.
Any attack on Philippine aircraft, vessels, or armed forces in the South China Sea would invoke our Mutual Defense Treaty.
But no one wants to start a war over rocks and reefs.
Just very recently that the U.S. and Chinese military officials finally were able to gather in a meeting that hasn't taken place in well over a year.
The last thing anyone would like is for conflict to arise. This is not poking the bear, as it were. We are trying to do quite the opposite.
Still, the combination of new leadership in Manila, rival claims on resources, and the presence of Chinese and U.S. military ships mean any accident can lead to unexpected consequences.
Leave immediately.
At one point, I was concerned that the smaller boat would sink and will not be able to withstand that much spray of water. Even from where we were, we saw how forceful it was.
Wars have been started over a lot less. Southeast Asian leaders are anxious over the prospect of a war between the U.S. and China, 2 partners that they depend on dearly, whether it be over Taiwan or in the South China Sea.
Terrific work there from our team. And of course, subscribers can see that Bloomberg Originals documentary in full right now. It's on the terminal and on Bloomberg.com. It'll also be up on their YouTube channel just a little bit later on. Plenty more ahead. This is Bloomberg. Here's your China Brief this morning. A look at what's making headlines in national newspapers and trending on social media. Well, China's State Administration of Foreign Exchange, or SAFE, is vowing to strengthen its FX supervision. This is according to a commentary in the People's Daily. They talked about the regulator working to prevent negative external spillover effects on the economy and crack down on illegal FX activity. Meanwhile, the Shanghai Securities News says that allowing the PBOC to buy and sell government bonds in the secondary market could actually boost its monetary policy toolbox. And the report also cited analysts saying it could ensure its effective transmission of macroeconomic policies while clarifying that it's not QE. And lots of state media commentary on U.S.-China relations ahead of Antony Blinken's visit. Now, Xinhua says the U.S. must recognize that dialogue is based on equality and respect. And it says one-sided lecturing or manipulation will not lead to constructive dialogue with Beijing. The Global Times, meanwhile, accuses the U.S. of spreading misconceptions about China in certain circles. Its opinion piece calls on Blinken to, quote, fasten the fast button before landing in China, and for Washington to remain clear-minded and avoid any misjudgments. Dave.
Yeah, there we go. Okay, speaking of visits here, just very briefly on sort of market reaction. So we're starting things off here with shares of, well, at least shares related to the Western region in China on the back of this visit and President Xi Jinping hosting a seminar in Chongqing on Tuesday, leading to the gains you're seeing on your screens. From this, we're pivoting to what's happening in Australia, where the hot CPI print has now pushed Westpac to push back their call on the first RBA cut to November from September. Plenty more ahead. This is Bloomberg.